Okay, hi everyone. I'm Carter, and I'm going to be making this videos on DTAs and DTLs, which I think is a commonly misunderstood topic within finance and investing. And just a disclaimer, this is going to be made more for someone investing or doing a valuation than it would be made for an accountant. So I'll just get into it. So basically, to set the stage, the reason that all of this exists is because there's a mismatch between the goals of the IRS, the department that is taxing companies, and the people who create accounting rules. So in the US, the FASB that oversees GAAP. The IRS just really wants to incentivize behavior from companies that will add value to society. So if there's something that a company does that is good for society, maybe they'll give that favorable tax treatment and maybe unfavorable tax treatment to things that are bad for society. Whereas the FASB just really wants companies to report in a way that's fair and makes it where investors can understand the true economics of a business. So here's kind of an example where there's a mismatch between what the IRS wants and what the FASB wants. So in 2017, as a part of the Tax Cut and Jobs Act, there was a new rule where companies are only allowed to deduct 30% of their EBIT with interest. So you can think of it as interest is typically good for companies because it means that they can deduct that and pay less taxes. But the problem is that incentivizes companies to lever up, which can oftentimes maybe result in bad outcomes like a bankruptcy, which results in a lot of people being laid off. So I guess the government just didn't want to promote that as much. So they're like, all right, we're going to allow you to deduct interest, but we're going to put a cap at 30% of EBIT. There's no reason for companies to lever up an insane amount. But because of this new rule, it makes it where the taxes a company should pay, in theory, on the books, just the pre-tax income times the tax rate, are different than what they actually pay. So just an example of this, let's say that there's $100 in EBIT, $50 in interest, and a 20% tax rate. In theory, this should be very simple. There's 50 in pre-tax income times 20%, that's $10 in taxes. However, as a result of this new rule, now they can only deduct 30% of EBIT. So a max of 30 in interest can be deducted, meaning that you're going to be taxing at $70 instead of $50. You're going to be paying 14 in taxes, 70 times 20%. So what it's going to look like instead is 100 in EBIT minus 50 in interest minus 14 in taxes. So you can see there's just a discrepancy in what's actually happening here from an IRS perspective, what you're actually paying, and what the books should say, that perspective. And that's all because of the differences in what the IRS wants to promote and what the FASB wants to promote. So getting into DTAs and DTLs in particular, a deferred tax asset, a DTA, arises when a company pays more cash taxes than book taxes. So this kind of makes sense, right? If you think of it as you're overpaying your taxes relative to what your books say you should pay, that's an asset. Where a liability arises when a company pays less cash taxes than book taxes. Paying less than you theoretically owe makes sense that that would create a liability. But these things are going to reverse over time because they are due to temporary differences between book and cash taxes. Just a quick example, I'll get into more depth later. If a company writes down an asset, you would think because there's going to be an asset write-down expense that the company would immediately be able to deduct that expense. But the IRS doesn't want people to just write down things for no reason. So they'll really only allow you to deduct that when you actually realize the loss. So if my building burnt down and like half of it burnt down and it's worth half as much, I'm not going to be able to get a like tax deduction from this unless I actually realize this loss by selling the property in simple terms. So, but when I sell it, that will reverse. So there's going to be a temporary difference, kind of like accrual and cash basis accounting between when I'm actually like incurring taxes when I'm actually paying for them in cash. And that's going to be creating a DTA and DTL kind of similar to all the networking capital line items in a sense. So again, DTAs and DTLs are due to temporary differences, whereas there's other things that arise due to permanent differences. For example, the Tax Cut and Jobs Act, that is never going to reverse itself. The company is always going to be overpaying what the books say if it's deducting more than 30% of EBIT. And when there's a permanent difference like this, that's actually going to be reflected on the current year's income statement. So it's not going to be the simple pre-tax income times tax rate. The FASB GAAP, they'll actually keep in mind, okay, what did the company actually pay? Because that's important for investors to understand. So the logic here is basically when there's temporary differences that will work themselves out over time, there's no need to confuse investors with volatile taxes. Whereas the permanent differences are important for investors to be aware of, and they just report it as so. So that's kind of the reason for all this. But just the main thing to take away is that DTAs and DTLs reverse over time because they're due to temporary differences. Temporary differences, DTAs, DTLs, permanent differences, not DTAs and DTLs. So just to figure out what the actual amount that will show up on the balance sheet is, a DTA, which again happens if cash taxes are higher than book, is cash taxes minus book taxes, whereas DTL is the opposite, book taxes minus cash taxes. And it's very similar to how current operating assets work for a DTA. If it goes up, if the DTA goes up, it's going to be a cash outflow. If it goes down, it's going to be a cash inflow. And for a DTL, if it goes up, that's a cash inflow. If a DTL goes down, that's a cash outflow. So looking more into DTAs, DTAs are created when a company pays more cash taxes than book taxes, and this is arising due to temporary differences. And some examples of that are net operating losses when a company is unprofitable, stock-based comp, and then write-downs and goodwill impairment. So getting more into NOLs, which is net operating losses, when a company has negative pre-tax income, the government will not pay them cash directly that period, but it will allow them to use that loss to offset future profits. So what this means is that my business generates negative 20 of pre-tax income and I have a 20% tax rate. You'd think, okay, the government will give me $4 in taxes because I lost money. That's not actually what happens though. That might show up on your book, but what's really going to happen is that the government will allow you to have a deferred tax asset. And in future years, when you're profitable, you can basically offset some of your taxes with that earlier NOL, the DTA that the NOL created. And just some rules on NOLs, I'll get into the specifics in that slide. There are no carrybacks. You used to be able to basically offset the current losses against earlier profits and basically get a refund for taxes you paid earlier. After the Tax Cut and Jobs Act, that's not allowed. And also sometimes you can't use a NOL over just like 1 year. Oftentimes you have to use it like you can only use part of it for 1 year and then you use part for the next year. So just to get into an example to make this more simple, in year one, if a company is negative 10 in PTI, how does that affect the three statements? What's going to happen is, first, let's just think of, is there a DTA getting created? And yes, there is, because we have $0 in cash taxes because the government isn't actually going to give us money. But our books are going to say we have a $2 tax shield, negative $2 in taxes, because negative 10 times 20% is negative 2. So you can see 0 is 2 higher than negative 2. So we're going to have a DTA of $2 created because, again, the formula for DTA is cash taxes over book taxes. So 0 minus negative 2 is 2. So we're going to have a $2 DTA. On the income statement, you never have to worry about any of this stuff. That's a good rule of thumb. Income statement is what GAAP is saying, so none of this is relevant. The cash flow statement is where we go in and correct all of this and make it right. So on the income statement, very simple. We have $10 of PTI negative, then $2 shield, net income down 8. But then on the cash flow statement, we are going to have net income down 8. The DTA is going to increase, which is a cash outflow of $2. So our net change in cash is going to be $10. Again, when an asset goes up, a current operating asset or a DTA, that's a cash outflow. So it's going to be negative 8, and then you're going to add the negative 2 to it. That's negative 10, which kind of conceptually makes sense because we're losing $10 and it's not tax deductible. We're just going to lose $10 if nothing else is happening. And then on the balance sheet, cash is down 10, DTA is up 2. And our retained earnings are down 8. So assets are at negative 8, retained earnings negative 8, balances. Now let's say it's year 2 and the company has $10 in pre-tax income. how does that affect the three statements, assuming a 20% tax rate, and that we can use the entire null in 1 year? So this is where you kind of benefit from that earlier law. In this case, we're now going to not pay any taxes because we're going to be able to use that null from earlier. Because we lost money and that created a DTA, we'll be able to use that to offset the taxes that we should be paying. Because in theory, $10, 20% tax rate, that's 2 in taxes. But in reality, we can use that null, which makes it the DTA the null created, which makes it where we pay 0 in cash taxes. We have 0 in cash taxes because we basically had 10 in pre-tax income minus the $10 null, 0 in taxable income, times 20%, 0 times 20%, 0. And then we had 2 in book taxes, just 10 times 20%. And this is creating a DTL of $2, or in this case, causing the DTA to go down $2, which is effectively the same. If we just saw this stand alone, 0 in cash taxes and 2 in book taxes, I would think, okay, I paid less cash taxes than book taxes. That creates a DTL. But in this case, we know that a DTA was already created, and it's basically just offsetting that. So really, it's a DTA going down, but it's the same basically. A DTA going up and a DTL going up and a DTA going down are both cash inflows. So on the income statement, very simple: 10 in pre-tax income, 2 in book taxes, 8 in net income. And in the cash flow statement, we have the $2 decrease in the DTA, which is the cash inflow. So we have a $10 net change in cash, which conceptually makes sense because we have $10 in pre-tax income and we're not paying any taxes because we're using the DTA that the null created. Just a few things to review. A null creates a DTA, which is what will actually be on the balance sheet. So you're never going to see null on the balance sheet. You're going to see DTA, which is because the null was created. But the most simple way to do the calculation is to do the current pre-tax income minus the null you're using times the tax rate. So in this case, we have $10 in pre-tax income minus the $10 null times the tax rate, which is 10 minus 10 is 0 times 20%, which is 0. Or the other way to do it would just to be like, all right, I'm supposed to pay 2 in taxes, but I have a $2 DTA from a null. 2 minus 2 is 0. Either way, it's the same. And the null is just going to be the pre-tax income times the tax rate. So I guess it should be negative pre-tax income times the tax rate. It used to be like negative 10, which is 10 times the tax rate, 20%. Creates a, sorry, this should be, this is just a little mistake. This should be the DTA equals the pre-tax income, or the null, same thing, times the tax rate. So if you have a $10 negative, like a loss, times the tax rate, that's going to create a $2 DTA. So I guess really this should be negative null times the tax rate. So negative 10 is 10 times 20% is 2, which is what the DTA was in our example. Let me just get back to where we were. And nulls can actually be a valuable asset for a company that has been unprofitable for a long time. So if there's a company that's had like 5 years of negative earnings, if they actually become a good company, this will be great for them because they will not actually have to pay taxes. But that's a big if, right? But a company like Amazon that lost money for a very long time is going to actually benefit a lot from all of those nulls that have created DTAs. And sometimes when you're doing a valuation, you actually have to value a null or the DTA that the null creates, the same thing. And the way to do that is just to figure out all the future tax savings and then discount them back to present value. Some people think you should use WACC to do this discount rate. Some people think you should do cost of equity because the equity holders are the main ones that are going to be benefiting from this because taxes are after interest, which is how debt holders are paid. There's difference of opinion on this, but that's just something to keep in mind. But you discount these all back to present value, either using the cost of equity or the WACC. Now to get into some other ways the DTAs are created. Other things that cause them are stock-based comp, asset write-downs, and goodwill impairment. And these are all instances of an expense showing up on the books before the IRS actually allows a company to benefit tax-wise from the expense. So basically, this just results in higher cash taxes than book taxes. So for instance, the IRS won't allow a company to deduct SBC, stock-based comp, until the shares actually vest to employees. So if I give shares to my employees, but they don't vest for 5 years, it's going to show up as an expense now, but I won't actually get the tax shield until the employee gets those shares. So it's going to create a DTA, but once the shares vest, the DTA would go down. And another example is, which I kind of went through earlier, is the IRS won't allow a company to deduct any kind of write down or impairment unless the company actually realizes the loss. So if the loss happens, half the building burns down. Sorry, if the impairment happens or write down happens because half the building burns down, that is going to create a DTA. But when I actually realize the loss, I sell the asset, then the DTA would go down. So all of this, again, is temporary, which is why it's creating DTAs in the first place. Quick example of SBC. Remember, the income statement is always normal with these things. Never try to show the effects of the DTA or DTL in the income statement. It's always very simple, just pre-tax income times the tax rate. So in this case, stock-based comp and expense, pre-tax income is down 10. We have a $2 tax shield, so net income's down 8. Then you think of it as, in actuality, we don't have a tax shield, right? Because the shares haven't vested yet. They're probably going to vest down the line. So what's going to happen is you have -2 in book taxes. You have this $2 tax shield, and you have 0 in cash taxes. 0 minus -2 is 2. You're overpaying, in a sense, by $2. So that's a DTA of $2. Again, you have 0 in cash taxes because this is a deductible, and -2 in book taxes because that's showing it as deductible, a shield, even though it's not. So you have a DTA of 2. SBC is non-cash, so we add it back. So the net change in cash is 0, which like conceptually makes sense because SBC is non-cash and we're not paying any taxes. So, or getting a tax shield. So nothing happens. And then the DTA is up 2, retaining earnings are down 8 from the net income, and the common stock is up 10 from the SBC. Now getting into DTLs. Again, DTLs are created when a company pays less cash taxes than book taxes, and this arises due to temporary differences. A DTL going up is a cash inflow, very similar to a current operating liability. A DTL going down is a cash outflow. Again, very similar to a current operating liability. Accounts payable going up is a cash inflow. Accounts payable going down is a cash outflow. And some examples of DTLs being created are due to accelerated depreciation or asset write-ups, which are oftentimes in the context of an M&A deal, which I'll get into. So this is what accelerated depreciation looks like. So usually you kind of think of depreciation as just being like a straight line. So if I buy an asset for $100 and depreciate it over 5 years, I would incur $20 of depreciation every year, the same amount. But in reality, the government allows companies to depreciate their fixed assets faster than the straight line method. This is because it incentivizes companies to reinvest in their business, because it doesn't really matter how fast you depreciate an asset, you're still going to cumulatively have the same amount of depreciation and taxes. But if you can get the tax shield up front, from a time value of money perspective, I'd much rather just depreciate the asset at the beginning and not pay taxes then than to collect a tax shield over like a 10-year period. So it's all due to the time value of money that companies would like to accelerate their depreciation. And you can see the maker's method is the main accelerated depreciation method, which you can see on the right. So you can see that you're depreciating it a lot faster at the beginning than at the end. But because of accelerated depreciation, there's a mismatch in what the books are saying and what you're actually paying in taxes and cash. So for example, for GAAP purposes, depreciation is shown using the straight line method. And the reason for this is because there's no reason to create like a volatility in depreciation and your net income as a result. That just creates a lot of confusion for investors. So instead, the GAAP and on your income statement, you're just going to show your depreciation is the same amount every year. But if the IRS is allowing you to accelerate your depreciation, it's going to create a mismatch. So let's just illustratively say that we buy an asset for $100, 5 years for life, no established value. So the straight line would just be 20 every year. But let's say that we can accelerate the depreciation. So it's 30, 30, 20, 10, 10. So it's going to add up to 100, just like the straight line version, but we'll be able to get the tax shield quicker. So there's going to be that temporary mismatch. So with the depreciation is accelerating, meaning that the accelerated depreciation is higher than the straight line, you are going to be creating DTLs. The DTL will increase. But when the depreciation is decelerating, when it is lower than the straight line depreciation, the DTL will decrease. So just to get into an example, let's say it's year one. So we're actually depreciating at 30 for IRS purposes, tax purposes, but it's 20 for book purposes. First, let's just see what the DTL will be. So if we have tax or cash depreciation of $30, I prefer to say tax because depreciation is non-cash, but you can say either. Let's say tax depreciation of 30. That's going to create a $6 tax shield, right? 20% of 30. And then the book depreciation of 20 is going to create a $4 tax shield, which is going to create a $2 DTL because we have -6 in cash taxes and -4 in book taxes. So we have $2 more in book taxes, which is going to create a $2 DTL. So remember, the book is always what the GAAP wants. So it's just going to be the $20 of depreciation because the books are going to use the straight line method. So we're going to have -16 in net income. And then the cash flow statement is where we actually show the effects of the DTA or DTL. So we're going to have -16 in net income, add back the depreciation, and then the DTL is increasing, which is a $2 cash inflow, which makes sense, right? We're benefiting from the accelerated depreciation. So the net change in cash is $6, which makes sense because that's the tax shield we are getting from the accelerated depreciation. So this is showing what we actually got as the tax shield. And then you can see the balance sheet here. It's going to end up balancing. And remember, for book purposes, always use the actual book depreciation of $20. Never use the $30 accelerated depreciation. That is only for figuring out the DTA and DTL. So now let's look at year 4, where the depreciation is decelerating. We have $10 in tax depreciation and 20 in book depreciation, the same straight line amounts. This would result in a $2 decrease in a DTL. Our book taxes are -4 and our cash taxes are -2, meaning that we are really kind of overpaying our taxes. Our cash taxes are more than our book taxes. So you could say this is creating a DTA or like a DTA going up or a decrease in a DTL. They're the same thing, but more appropriate probably to say the DTL is decreasing here because we already had that DTL. So this is going to result in a $2 cash outflow. And you can see it's very similar to what happened earlier, except now our net change in cash is only $2 instead of $6. So I made this little Excel to like show how this ends up working. You can see that in the early years, year 1 and 2, we get more of a tax shield. But in the later years, using accelerated depreciation, we get less of a tax shield. So over time, we're paying the same amount in taxes, or I guess more appropriately, we're getting the same tax shield. It's just the accelerated depreciation is better from like a time value of money perspective. And you can see the DTL goes up to 4, and then it goes back down to 0 because it's all due to these temporary differences. Lastly, looking at DTLs and M&A deals. So in M&A deals, goodwill is calculated by figuring out the purchase price for the company's equity and figuring out how much more that was than the fair value of the company's said assets. But the fair value of a company's net assets is different than what actually shows up on the books. You're going to have accountants or people go in and do fairness opinions of the assets. And oftentimes assets such as like IP or PP&E are written up to reflect the fair value of the company's assets when making like the combined balance sheet. So the problem with this is that it creates DTLs because the government doesn't want a company to benefit from a tax shield twice. For instance, let's say I bought a $1 million house. I'm a company, I have a house for some reason. I depreciated over 5 years to $500K. And then all of a sudden there's an M&A deal. And I'm like, you know what? That house is actually still worth $1 million. The government wouldn't want you to depreciate that again and benefit from the tax shield twice, because what would stop someone from just continually writing up their assets and it's just like a infinity tax shield glitch? They're not going to let you do that, so it's going to create a DTL. And how that's going to work is that, for example, if a company writes up PP&E from 100 to 200 following an M&A deal, because that like reflects the fair value of the assets, the DTL is going to equal the write-up amount times the tax rate. So in this case, it would create a $20 DTL. Is the better way to say this. So it's going to create a $20 DTL. And that is going to basically, let me get back to that slide. That is basically going to counteract the tax shield that's going to show up on the book. So it's going to look like because now the PPA is higher and the depreciation is higher as a result. It's going to look like they're getting more of a tax shield, but it's going to be counteracted by this DTL. So what's going to happen is as the asset is depreciated, the DTL will go down because the company's cash taxes will exceed the book taxes because there will not because there's going to be depreciation on the book, but that's not actually creating a tax shield. It's like a fake tax shield because the government's not going to allow it. So you can see here what's going to happen is that let's say that $20 DTL is being created and the asset's now worth $200. GAAP is going to say we're getting $40 of depreciation every year because the asset's worth $200. But the tax people are going to be like, no, that asset's worth $100. So we are going to only give you 20 depreciation. That's going to result in, sorry, this is backwards. It should be -8 in book taxes and -4 in cash taxes. So just, again, this is backwards. So this right here, the cash taxes should show up as -4. And then the book taxes should show up as -8. And basically what's going to happen here is over time, the DTL is going to go down because you're basically going to be benefiting from this on your book, but you're not benefiting from it in reality. So just to go through it, in year one, we're going to have an $8 tax shield on our books and a $4 tax shield like on our taxes, like our cash taxes. So what's going to happen is you are basically underpaying your taxes you're basically overpaying your taxes by $4, which is going to cause the DTL to go down over time. And again, the whole reason is because the government does not want you to collect depreciation tax shield twice. So this is just an example of like an M&A goodwill calculation. So if a company is paying $100 for another company with 200 in assets and 150 in liabilities, and the assets are written up to 220, how does this affect the pro forma balance sheet, assuming a 20% tax rate? So what's going to happen here is that if let's assume there's like no write-up, basically they're paying $50 for the net asset. So 200 minus 150 is 50 net assets. You're paying 100. That's going to create 50 in goodwill. But in actuality, we need to account for the write-up and the DTL that it will create. So what's going to happen is this $20 write-up will create a $4 DTL. It's just the write-up times the tax rate, which is going to increase the liabilities to 154. So our assets, which are now 220 after the write-up, minus 154 is going to equal 66 in the fair value of the net asset. The equity price paid 100 minus the 66 in fair value is going to equal 34 in goodwill. And then this is all going to balance. We're going to have fair value of assets up to 20, goodwill up to 34. Our cash is down 100 because that's what we paid for this business. And then the liabilities are up 154. And then this is going to balance. So that's just something to note when you're like creating a pro forma balance sheet. So now lastly, let's just get into like the enterprise value implications of all this. So for the EV to equity value bridge, the only thing that should be included is the fair value of the nulls. So nulls should be added to equity value because they are non-operational and as a result aren't going to show up in the enterprise value. Basically, you can kind of think of this as if you're doing like an unlevered free cash flow schedule, you're not going to take this into account because it's non-operational. Whereas for the other versions of like DTAs and DTLs, like accelerated depreciation or stock-based comp, that's more operational. So it should be reflected in the unlevered free cash flow schedule and the EV as a result. So you don't need to worry about them. So when you're doing the equity value bridge, you can kind of think of it as if you have a DTA from stock-based comp, that asset is already embedded in the enterprise value. Whereas with a null, it isn't embedded in the enterprise value. So you need to include it as a separate line item because it does accrue to the equity holders. So that is why nulls are included in this bridge. They're non-operational. You should treat them like another non-operating asset, whereas the other DTAs and DTLs are operational and are thus like embedded in enterprise value, which is like the value of the net operating assets of a business. That's all I have for y'all today. Thank you very much. I hope this cleared things up.